Amazon's retail business barely makes money, not lower margins than you'd expect. It barely makes money. In 2023, Amazon generated more than $500 billion in revenue, most of it from online stores and third-party seller services. Yet operating margins in North American retail sat in the low single digits. International retail has posted multi-billion-dollar operating losses in recent years. The core tension is simple. The largest retailer in history runs a business structurally resistant to high margins. Scale is supposed to create leverage. More volume should mean lower unit costs and wider profit. At Amazon, scale mostly lowers prices and speeds up delivery. Customers capture the gain. Shareholders depend on something else. The public narrative describes Amazon as a retail juggernaut built on efficiency. The deeper reality is that its retail arm functions more like infrastructure. It is engineered to maximize throughput, not margin. Capital flows in, prices stay low, selection expands, profit accumulates elsewhere. Retail is naturally thin margin. Gross margin measures the gap between selling price and product cost. Operating margin subtracts fulfillment, shipping, labor, and overhead. Most large retailers operate on low single-digit operating margins. The difference is that they aim to earn steady profit at each location. Amazon optimized for system dominance instead. The binding constraint is logistics. 2-day shipping sounds like a feature. Economically, it is a cost commitment. Warehouses must sit near dense population centers. Inventory must be replicated across regions to guarantee speed. Trucks, planes, and last-mile delivery networks must operate, regardless of daily demand swings. These are largely fixed costs. They do not shrink quickly when volume softens. As Amazon pushed from 2-day to 1-day and same-day delivery, capital intensity increased. Billions were deployed into fulfillment centers, robotics, sortation hubs, and delivery fleets. Faster promises require more inventory positioned closer to customers. That raises carrying costs and the risk of overstock. Speed improves conversion. It also compresses margin. This creates a persistent trade-off. Amazon can widen retail margins by slowing delivery, narrowing selection, or raising prices. Or it can reinforce its moat by doing the opposite. Historically, it has reinforced. The pandemic exposed the mechanics. In 2020 and 2021, demand surged. Revenue climbed sharply. Retail operating income did not expand proportionally. Instead, Amazon doubled its fulfillment footprint. When demand normalized in 2022, excess capacity collided with rising labor and transportation costs. International retail reported operating losses exceeding $7 billion. Scale amplified both expansion and contraction. When utilization fell, margins collapsed. The contrast with Amazon Web Services makes the structure visible. AWS regularly posts operating margins above 25% and often generates the majority of total operating income despite representing a smaller share of revenue. Retail drives volume and ecosystem lock-in. Cloud computing generates profit. The retail engine feeds a higher margin core. The marketplace model reinforces this dynamic. More than half of items sold on Amazon now come from third-party sellers. Amazon collects fees for fulfillment, storage, payments, and promotion. Those fees carry higher margins than first-party retail, where Amazon owns the inventory. Yet marketplace sales still depend on the same logistics network. Shipping a third-party product is not materially cheaper than shipping Amazon's own. The infrastructure remains the cost center. Advertising adds another layer. Sellers pay to promote products within Amazon's search results. This advertising business now generates tens of billions in annual revenue with strong margins. But it exists because retail traffic is massive. The low-margin retail engine creates attention. Advertising monetizes it. Greater disclosure of segment operating income clarified the inflection point. Even in high-growth years, retail contributed modestly to total operating profit. Amazon Web Services consistently carried consolidated earnings. The contradiction was no longer perception. It was embedded in the income statement. Why not simply raise prices? Because Amazon's strategy centers on customer surplus, the difference between what customers are willing to pay and what they actually pay. By compressing prices and improving convenience, Amazon increases that surplus. Retaining it as profit would invite competition. Passing it through reinforces loyalty and scale. Low prices also pressure rivals. Brick and mortar retailers carry leases, in-store labor, and local inventory constraints. Amazon eliminated storefronts but added shipping and fulfillment complexity. To sustain its advantage, it must continually invest in the network. That investment keeps margins tight. Prime membership integrates the system. For an annual fee, customers receive fast shipping and digital benefits. Economically, Prime increases order frequency because shipping feels free at the margin. Higher frequency improves warehouse utilization and lifetime value. But Prime also locks in expectations. Once customers internalize rapid delivery as standard, slowing down risks churn. The promise becomes a permanent operating cost. Working capital plays a role. Amazon often receives cash from customers before paying suppliers. This negative working capital improves cash flow and funds expansion. It strengthens liquidity, not operating margin. Returns add further pressure. E-commerce return rates exceed in-store rates. Each return triggers reverse logistics costs, inspection, restocking, or liquidation. Easy returns increase conversion and customer trust. They also reduce profitability per transaction. Amazon accepts the trade-off because frictionless buying expands volume. Labor remains a major variable. Warehousing and delivery are labor-intensive. Wage inflation directly affects cost per order. Automation reduces some pressure, but requires capital investment. Each productivity gain demands upfront spending. The system constantly substitutes capital for labor while protecting delivery speed. Margin remains constrained either way. These dynamics explain why a $500 billion retail operation produces supermarket-like margins. The outcome is not operational failure. It is strategic design. The events of 2022 clarified the boundaries. Inflation raised transportation and labor costs. Demand growth slowed. Retail operating income swung sharply. Investors questioned sustainability. Amazon responded by regionalizing its fulfillment network, reducing shipping distances, and trimming excess capacity. Margins improved modestly. Retail did not transform into a high-margin business. It became more disciplined. The broader lesson extends beyond Amazon. Some companies treat their core product as a profit center. Others treat it as a platform that supports higher margin activities. When a business behaves like infrastructure, it often compresses margin at the edge to strengthen the center. For Amazon, retail is the edge. AWS and advertising sit closer to the center. This reframes competitive risk. Matching Amazon on price and speed would intensify margin pressure. Replicating its logistics network, however, requires enormous capital and tolerance for thin returns over long horizons. Few firms possess both. The barrier is financial endurance as much as technology. Amazon's leadership has long emphasized long-term free cash flow over near-term profit. That philosophy aligns with a model where retail profit remains modest while the network compounds in strategic value. There are limits. If cloud growth slows or advertising margins compress, the cross-subsidy weakens. Retail would need to stand more independently. That tension persists beneath the surface. Recent operational changes suggest incremental efficiency gains are possible. Regional fulfillment reduces average shipping distance. Better inventory placement reduces split shipments. These adjustments lower cost without sacrificing speed. Yet even with optimization, retail resembles a utility more than a software business. The opening contradiction holds. Amazon built the largest retail machine in history and engineered it to earn thin margins by choice. The retail system prioritizes scale, speed, and ecosystem gravity over standalone profit. The benefit is not captured in retail operating income. It accrues to the platform built on top of it. Revenue measures activity. Margin reveals intent. In Amazon's case, retail was never designed to maximize profit. It was designed to become indispensable.